Good day, fellow investors. A very requested stocks is always Canadian National Railway. You say here that it has a relatively low P ratio of 17, that's a great company, great moat, doing great, very progressive on that trains, and that it should be a good buy. As always, we look at the stock, at the business, the risk and reward, valuation, and whether you should own it in your portfolio by looking at our value investing quadrant. So let's immediately start. Whenever a stock is down 30% like Canadian Railway, I always get a lot of comments, is it now a buy? Because many of you expect it to go up. The dividend yield is 2.73, P ratio 18, market capitalization 58 billion US dollars, 80 something billion Canadian dollars. Let's look a little bit at the numbers, and if you look at the situation, it is somewhat mixed. Some things are going down, some things are going up, but results also more stable than other. A little bit increase in free cash flows, a little bit increase in earnings per share, operating ratio a little bit down, operating income same. So if you look at what's going on, volume is down a little bit, mix down, prices down, and then cost takeout, same store price, foreign exchange, and you are stable. They have lowered a little bit the EPS outlook, so they now expect to deliver mid-single digit to high single digit growth adjusted. Always keep in mind that adjusted diluted earnings per share growth. However, if I look at the long-term situation with this company, if we look at operating income, it grew a little bit, but not really that much. Net income, it has its ups and downs, but it is alongside the cycle pretty much stable at this 5 billion situation. However, the first red flag here is net income is stable, but what happened with the debt? The long-term debt was about 10 billion and now it's 20 billion. That is a 2x in debt. When that happens and you see net income not really getting traction, if you double your debt, you expect also net income to double, but that has not happened. Why? Because they focused on buybacks. This is 2022, 2023. They spent 10 billion on buybacks, likely 2022. So when the stock was much higher than now and when there was a lot of exuberance. So they have spent the money and the debt is still there. When you summarize things a little bit, this is a pretty stable business, and the basis of that earnings growth was a little bit of operational improvements here and there, and then buybacks to grow earnings. If you buy back stocks, then earnings should grow. However, that is pure financial engineering that works until it doesn't. When that debt pile, the interest payments start to revert the benefits of those buybacks, and the benefits of those buybacks have been reflected in higher and higher stock prices. Now that the buybacks, the huge buybacks are gone, the stock price is suffering. And a severe economic downturn would hit this severely, but let's look at the price compared to the value. The stock is down, okay, and here you see the financial engineering. When they started pushing those buybacks, they really increased the market cap. When the market cap was here 30 billion, if you spend 10 billion, yes, you make it to 2x according to the market inelastic hypothesis that where every dollar invested in the market increases the market cap by $5. So that is what happened here, and now that that is reverting, it can get even uglier. Because they are also not really growing organically. Everything is dividend and financial engineering because there is a lot of capex just to keep things operating. So the capex is growing, but I'm not seeing growth in earnings, which means another small red flag when it comes to investing. Then if we look at the real value creation, let's say 3 billion, then the P ratio is not 18. They're using that money into higher capex to try to keep things stable and grow. So the real P ratio is 27. That's also reflected in the dividend yield and the lower buybacks now. The main risk here is if there is a downturn, then the buyback is money gone in the wind, especially at higher prices. That financial engineering effect reverts. What is left is the 10 billion additional debt that the company has to deal with, and then this trend can look much, much uglier. And I have seen this happen. I've done, for example, Restoration Hardware, a stock that must go up, and this was done 5 years ago. I think the stock was at 90 or something. The stock went up 7x. This was financial engineering on steroids because they were issuing convertible debt to do buybacks. At the end, we are again back to where we were. So it works. You have to sell while it works, and when it reverts, you have to get out. However, I also look, this is from SA, a lot of articles, everyone is very bullish on the company, buy, 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 buy. If I look at the articles, defensive, how can a railroad be defensive? Railroads don't make money in recessions. Okay, operational efficiency, free cash flow, 12 to 16% annual growth, and I've looked a little bit of how are they going to see that, estimate 9 to 13% growth over the next 3 years. With the dividend, that's 12 to 16% growth range. Okay, and then I look at what analysts are saying. Yes, everyone is expecting 10% growth going forward on earnings. This might happen, this might not happen. If the US hits a recession, even Canadian exports and movements are, of course, connected. Therefore, you have a bad situation, lower prices, lower profits, and that can last for a year or two, as it was in 2010 when Buffett bought Burlington Northern Santa Fe at a much lower prices than earlier. And if I put the 3% yield with perhaps some growth here, maybe some here, but due to the risk, I'm not going to follow this on my quadrant because I prefer, let's say, lower risk, better yield situation on YouTube, and you can always check the best ideas I have on my research platform, link in description below, 21-day money-back guarantee. Check it for context. So my conclusion is, yes, it might rebound, everyone likes it, but it seems that everyone is looking from a relative perspective. A 2% yield is not enough to justify investing in railroads. Warren Buffett bought Burlington Northern Santa Fe in 2009-10. By 2015, he got his money out, everything that he paid through dividends. You will need 40 years to get your money back now if you invest now. Thus, not the time. It might look better than it looked a year ago, too risky from a value investment perspective. And there are these red flags where the business isn't really growing, they are spending on financial engineering. So, not something to really like in someone's portfolio. Thanks for watching. Check my research platform, my performance. I'll see you in the next video.